Welcome to Get Rich Education. I'm your host, Keith Weinhold. In real estate, as a cash flow investor, you have lower risk. Investing for appreciation exposes you to higher risk unless you're disciplined enough to stay in for the long haul. I'll discuss how long. It's cash flow versus appreciation today on Get Rich Education. How would you like to look at one of America's top real estate investment markets up close and personal with me, Keith Weinhold? Let's do this together in Tampa Bay, Florida on our Tampa real estate field trip, October 10th to 12th, 2019. New residents have been flocking to Tampa for decades with its warm climate, low cost of living, zero state income tax, and access to some of the nation's best beaches. Enjoy an opening night meet and greet with me and fellow Get Rich Education listeners just like you, classroom instruction from me and my Tampa team. Finally, we'll tour the investor advantage neighborhoods and walk cash flowing property. I'll even treat you to lunch. There are no properties for sale on the tour. If you're interested, you can contact the provider later. Get all the details at realestatefieldtrip.com. It's Get Rich Education's Tampa field trip, October 10th to 12th. Space is limited, and when it's gone, it's gone. We've even kept the cost down for you. So get all the details and register for the event at realestatefieldtrip.com. I look forward to meeting you personally in terrific Tampa. Get started at realestatefieldtrip.com. Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Cerro de Pasco, Peru to Pasco, Washington, and across 188 nations worldwide. I'm Keith Weinhold, this is Get Rich Education, and you are back in that abundant place where financially free beats debt-free. When you're thinking about buy and hold real estate investing for the long term, you've got to consider what happens in an up market versus what happens in a down market. Last week, I painted about the most somber picture possible when I talked about what you might do if descending into another Great Recession type of atmosphere. Well, what's more likely is a recession. They're milder. They tend to occur every 5 years, though that period of time can fluctuate wildly. So yes, the current run-up here is getting long in the tooth, and a recession lasts for a year and a half on average. Well, long-term rentals are more likely to weather these downturns than short-term rentals are. I'm talking about short-term rentals like Airbnb and VRBO. Those cater more to the vacation crowd. They're those people that have discretionary income. Well, more people have that extra money only when times are good. Vacations and hospitality, they're real estate segments that really get beaten up in a downturn. Short-term rentals like Airbnb are not as recession resilient as long-term rentals. Now, that's not to say that you're absolutely never going to invest there, but that could be one substantial reason as to why you limit your exposure there. As an investor and not a speculator, you probably either stay away from stocks or you limit your exposure to stocks. For everyone but the most sophisticated stock investors, you probably have no leverage in stocks. Therefore, you would need to hold 100% equity in stocks and in mutual funds. In real estate, you're used to calculating your cash-on-cash return. That's your annual cash flow divided by your all-in amount, your down payment and closing costs. Well, did you ever think about calculating your cash-on-cash return on your stocks? Did you ever calculate your cash-on-cash return on your mutual fund? It's probably exactly 0%. It also has zero chance of becoming greater than 0%. Now, unless you're really into dividend-paying stocks and you actually take the dividend rather than reinvesting it, but even then, the average dividend-paying stock in the S&P 500 yields 1.9%. So maybe you don't speculate at all, or maybe you've got more discretionary income than some people, and you like to earmark, say, 10% of your portfolio or whatever it is toward these more speculative holdings. So why is a great answer long-term rentals in more stable geographic markets? They're sort of in the B or B minus class or C plus class or even C class, and what we call working class housing. Well, it's recession resilient. Cash flows are fairly predictable. And with your up to 5 simultaneous profit centers, total returns of less than 20 to 25% are actually disappointing. That's why we're in this. How many dollars per square foot should you spend on these types of properties anyway? These stable markets in the United States, Midwest, and South, where you can generate cash flow with an 80% loan, you're often looking in a range of $70 per square foot on the low end, up to about $150 per square foot on the high end. If you're spending much less than $70 per square foot on these properties, well, you run the risk of getting into an area where tenant quality is so low that they might not actually pay the rent. Now, there are a few notable exceptions to this. Memphis, Tennessee, for example, is one of them, where the lower price points still do work. If you're spending much more than $150 per square foot, then your cash flow is probably gone. So that's roughly the sweet spot range, $70 up to about $150 per square foot in purchase price. So what is perhaps the most difficult part about long-term residential rental property? It's getting started. You know when your worst return on time invested occurs? It's at transaction time. It's doing those things like getting your financing in order, getting your property under contract, performing your due diligence, getting your third-party inspection and then your appraisal, signing your management agreement, and then closing. Well, now that's great. You're collecting rent checks, but that first one is the hardest. After your first one, now you begin to get a bit of a system down. You're doing things like you're saving your previous 2 years' tax return in a digital file system because you know that your mortgage underwriter needs those, for example. You've got your property photos in a Dropbox folder. You're just setting up those elements so that you can be a prudent asset manager yourself over your property manager and checking them. You've only got to do a lot of those things once, and that is the hurdle of getting that first property, after which it gets easier, and your return on time invested goes up throughout your investment career because you become a better investor. So we're talking about some of those fundamental whys for long-term rentals today, and that is appreciation versus cash flow. Join me October 10th to 12th for our Tampa real estate field trip. It is actually based at the Hyatt Hotel in nearby St. Petersburg, Florida. Thursday, you'll have an opening night meet and greet. Friday, I and others are speaking about real estate investing in the Tampa area. Then Saturday, we load up on the coach and visit investor advantage neighborhoods and walk cash flowing property. Those areas are about 45 minutes north of Tampa, St. Pete, by the way. Learn more and register, if there's still availability, at realestatefieldtrip.com. I am co-hosting the event, and you'll notice over there that the itinerary does not include any of these long, drag-out days where it's like 10 or 12 hours worth of speakers. From my experience with events, that is just too much. So there are fewer speakers, and there are more breaks so that you can network with other like-minded attendees. And I expect that you and I can have a casual chat too. We're talking about Florida a bit more on today's show too, along with cash flow versus appreciation. Today's guest is the co-founder and CEO of JWB Real Estate Companies. They build and sell rental properties, and they also provide the property management services for you right there in-house. In fact, he currently has 3,000 properties under management and a team of over 80 employees, many of whom I've met in person when I visited their main office in Jacksonville, Florida last year. They serve over 1,000 clients just like you, both around the country and the world. They've received numerous awards, more than I can mention here, like being a 7-time honoree of Inc.'s Fastest Growing Companies Award and the Best Places to Work Award. They've been featured in the Wall Street Journal. Last year, they even built a new home and completely donated it to a wounded warrior. Welcome back to Get Rich Education, Greg Cohen.
Thanks, Keith. Great to be here, buddy.
Let's talk about how to evaluate home price appreciation when you're considering a cash flow market. A lot of investors are out there predominantly looking for cash flow, not always, but when one considers cash flow first, they also need to think about the importance of factoring in home price appreciation when making their investment decision. Talk to us about that.
It's a really important topic right now. As we've seen home prices go up over the last few years, a lot of clients, a lot of investors ask us, how and when should I evaluate home price appreciation when it comes to my decision of where to invest? And because when you start to run the numbers, if you only pay attention to the cash flows, you're missing a large component of returns. And Keith, I love your podcast. You talk about the different profit centers that come along with rental property investing and the advantages, especially if you have a leverage portfolio. You really run those numbers. If you're only paying attention to the cash flow part of this total return, you're missing out on a lot of potential return. And the risk here for those investors who don't pay attention or at least have an eye to what home price appreciation can do is that after 5, 10, 20 years of owning these rental properties, there might be a huge miss and a large opportunity cost that they had they looked and paid attention to home price appreciation. So that's something that I think is really timely, and that's something that I'd certainly like to help your folks today with.
Appreciation versus depreciation in the capital value of a property is arguably even more important when you're a leveraged investor because leverage amplifies your wealth in an appreciating environment, and then the sword cuts the other way. It also amplifies your losses when the price goes down. So you've got to control it for cash flow. But one thing new investors don't realize is oftentimes, especially when they're leveraged, they feel more financial benefit over the years from leveraged appreciation than they do cash flow.
It's totally true. And this isn't to say that we're going to go off the deep end and start being completely speculative and start buying assets that don't pay for themselves. What this is saying is once you meet that threshold where assets do pay for themselves every single month, then if we take an additional step and start to evaluate home price appreciation, that's really where you can supercharge your returns and really create this financial freedom that we're all looking for in 10 years, 15 years, 20 years of developing the strategy.
Why do you think investors don't take appreciation into account as much as they do cash flow?
It's for a few things. I think we are all remember what happened when values went down in 2008 and 2009, and we saw what happened there. So we're all a little bit sensitive there. There is a way to evaluate home price appreciation without it being speculative. But I think it comes down to some short-term pain that we evaluated, that we felt, that still is very present in everybody's mind. And so what they take from that experience is they say, well, I can never count on home price appreciation to happen in the future. I'm just going to strike it from the record. It's not going to evaluate. It's not going to be a part of my evaluation process. So there's an element of that. And then quite frankly, it's harder. When we're looking at cash flowing investments and we are trying to make a decision, it is much simpler for us to know the rental income minus the expenses and to figure out our returns based on the cash flows. And that is the historical way that cash flow investors have made their decisions. When you factor something else in there like home price appreciation, it complicates it a little bit. And then things are a little bit more complicated. People don't want to do it. It's not as easy. It's not as simple. And generally, people just don't do it. But again, if they don't, they're missing out on a huge opportunity. And so that's why it does need to be evaluated, in my humble opinion.
Appreciation is more speculative, cash flow is more predictable, and for any long-term buy and hold real estate investor, really you ought to evaluate a property on if you had to own that property for 20 or 30 years. Now, in all reality, you probably won't, but that's a smart way to evaluate things, a 20 to 30-year hold period, although it's pretty likely you're going to hold on to it for at least 5 or 10 years. And in the history of the United States, it's pretty difficult to draw a 10-year slice between any time period that's a decade long where the capital value of the asset is lower 10 years later than it was 10 years earlier.
You hit on a really important part of this because what we need to do is to create a mechanism for evaluating home price appreciation that is not speculative. And if you are in this for the short run, if somebody who wants to buy a rental property and you want to sell it in 1, 2, or 3 years, this discussion probably doesn't pertain to you because home price appreciation over 1, 2, or 3 years is completely speculative.
Yeah.
But if you are that type of a mindset that you just mentioned, you go into this planning to hold on for 20 years or 30 years, what you're going to notice is that real estate cycles tend to repeat themselves. You look back in Jacksonville, where I am and where I invest, even looking at the numbers from 2001 all the way to 2018, our home price appreciation came back to normal. The normal home price appreciation came back to itself. And we all know what happened as values went up from 2001 to 2006 and how they crashed after that and now have gone back up again. So markets tend to come back to the norm when you have that long-term mindset. And that's what allows you to count on home price appreciation, but it's only for those long-term investors, as you mentioned.
Now, you end up, whether it's in a formal or really an informal sense, advising a lot of investors and prospective investors. So talk to us about what your investment criteria looks like through your lens when you're talking to these investors.
I've had the blessing to own over 300 rental properties myself and help thousands of clients build their portfolios. So I can speak from experience here. And the things that I look at and that I advise my clients to look at is, number one, you have to invest in a market where the assets pay for themselves. That is the entry into this game, right? We do not want to invest in assets that do not pay for themselves every single month, because then you are speculative. You're hoping on home price appreciation to bail you out at some point. And that doesn't play for me and for our investors. So number one, you have to invest in an asset in a market where they have assets that pay for themselves every single month. What you also need to look at, the second point would be, you need to invest in a market that has a strong economic basis. And the thing that I look at to evaluate that is that they have over 1 million people there. If you invest in a market with less than 1 million people, you run the risk of there just not being a huge housing demand. But more importantly, you run the risk of 1 or 2 companies really changing the landscape of the investment in that area. If 1 or 2 companies should leave, that might take a tremendous amount of your renting or buying pool away from the real estate market. Never a good thing there.
When you have over 1 million residents, you have significant ballast, and you're almost certainly going to have substantially diverse economic sectors versus investing in the tertiary town that has 21,000 people where 40% of their employment is based on one factory or one industry.
Absolutely. The way you lose in rental properties is if all of your people stop renting. So if all of the jobs leave because a company leaves like that, that's a recipe for disaster. So you mitigate that risk by investing in those types of markets that you mentioned, those markets that have over 1 million people. So in my mind, that's the barrier for entry, right? Over 1 million people, and you have positive cash flow. It pays for itself every single month. But at that point, that's where I think clients and investors need to take that additional step that most investors don't do. And that's where you need to look at some of these short-term and long-term indicators for home price appreciation. Again, my mentality here is you're an investor who's planning on holding on for 20 years, 30 years. If you're not, then home price appreciation shouldn't matter to you. But if you are, you should start to look to these factors. So the next thing that you should pay attention to is population growth. In markets where population is growing, it should make sense to everybody that there's an increased housing demand. The next thing to look at is the markets that historically have a larger home price appreciation rate. And again, as I'm speaking to investors that are in for the long haul over 20 years or longer, that's where you get your historical home price appreciation rate. The theory here, and what's been proven over and over and over again, is that if you give yourself a 10-year, 20-year cycle, the market, the region that you're investing in is going to come back to the norm. And at that point, you can really bank on home price appreciation. So I think it comes down to those 4 factors, Keith. Positive cash flow pays for itself, 1 million residents, population growth in the market, and look for the ones that have the highest percentage of population growth and the highest percentage of home price appreciation over the long haul.
So in trying to predict home price appreciation, we want to look at exact leading indicators and specific numbers so that you can help forecast this as best you can. You're listening to Get Rich Education. Our guest is Greg Cohen. More when we come back on home price appreciation. I'm your host, Keith Weinhold.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit passiverealestateguide.com and get your free copy today. That's passiverealestateguide.com.
Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
Hi, this is Rich Dad Advisor Garrett Sutton. You're listening to the always valuable Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Greg Cohen about the role of home price appreciation when you're looking to purchase an income property. So, Greg, one of those indicators for home price appreciation is the months of inventory on a market. Tell us more about that.
What you're going to find is there are time-tested and true indicators that give you an idea of where home price appreciation will be, both in the short run and the long run. So when we're talking of months of inventory, this is a leading indicator for home price appreciation in the short run. And months of inventory should make sense to us as business owners. It doesn't matter what you're selling, but if you have a lot of inventory in your business and last month very little sold, you are going to have downward pressure on your pricing.
That's just the economics 101 of supply versus demand as indicated by the months of remaining inventory of housing stock.
Absolutely. And the opposite is true. If you had limited inventory and things are selling like hotcakes last month, you're going to find that you're going to have pressure to increase your prices. And what happens is the real estate market, of course, works the same way. So the way that we measure this is months of inventory. And this is something that all the listeners can do in their own market. What you do is you go to the multiple listing service. If you're not a realtor yourself, you can ask a realtor friend and simply ask them how many houses are on the market. That's your first number there. And then you look at how many houses sold on the MLS last month. You divide that number into it, and you're going to find your months of inventory indicator.
Exactly. And there are so many different ways to slice the months of remaining inventory, but any substantial metro market has that data. You need to slice, for example, condos from detached single-family homes. And then when you look at the months of remaining inventory for detached single-family homes, that might be sliced into a 300K to 400K segment and a 400K to 500K segment and a 500K to 600K segment, each one of those having their own remaining months of inventory on the market. But I think there's one general indicator that it comes down to, and that's really the 6-month mark.
Yeah, exactly. What you're going to find is that 6-month mark is really important. If history shows us that if you have less than 6 months of inventory, what you're going to find is that you're in a seller's market. That is indicating that you should have higher than normal home price appreciation over the next, call it 12 to 18 months. Conversely, if you have over 7 months of inventory, that's that buyer's market, meaning that there's downward pressure on pricing. Now, this doesn't mean that things are going to depreciate, but what it means is that you should expect lower than normal home price appreciation over the next 12 to 18 months. So if you run this metric, you should have a pretty good idea of where pricing is going to be in the short run.
And of course, that strikes some people as unusual that hear that for the first time. So if there is less than 6 months of inventory in the market, meaning if properties are moving in just an average time of 4.5 months, that might not sound fast, but relatively speaking, in a slow-moving asset class like real estate, 4.5 months on average is actually pretty fast and pretty hot because you have to average in all the homes here, some less desirable to own than others.
Absolutely. And there's really some compelling data. Keith, I pulled some data points, and I know we won't get too numbers heavy, but if you look back at 2006 to 2008 in Jacksonville specifically, what we saw was that there was extremely high number of months of inventory. And we all know what happened in 2006 all the way to 2008. Prices fell sharply. So just to share with you, 2006, we had 10 months of inventory. In 2007, we had 18 months of inventory.
Gosh.
In 2008, it was 16 months of inventory. And our pricing fell from about 200,000 all the way down to, well, it was 171 back in 2008 when I pulled these numbers. So it dropped dramatically.
That's a 15% haircut.
There you go, right? Now, fast forward to 2013, that's when things started to change. That's when the market started to appreciate in Jacksonville. And guess what months of inventory was at that point, Keith?
I think you got down to below 6, maybe even around 4.
We were below 4 in 2013, and we have been hovering between 2 to 4 months of inventory ever since. And what you've seen, pricing in Jacksonville, now this is one specific example, but it applies to a lot of markets out there. What you've seen is low months of inventory have equated to higher than normal home price appreciation. We had a median home price in 2013 of $166,000. In 2019, I pulled the data from April of this year.
Yeah.
Our median home price grew to $230,000. And it's because we've been between 2 to 5 months of inventory ever since.
So what does that look like for longer term home price appreciation, just using Jacksonville again?
That's what we're talking about the short run. Now, that needs to be evaluated amongst a lot of different factors. You don't make a decision just based on that. But you also need to look at the long-term home price appreciation. And I think the long-term home price appreciation is what gives investors confidence to evaluate it in their returns. When you compare a lot of the cash flow markets out there, you're going to see there's a huge difference between appreciation in a growth market like Jacksonville versus appreciation in a market like Cleveland, which is not known to be a growth market. And I don't mean to pick on Cleveland, but I just happened to pull the stats and they were there. When you look at home price appreciation over the last 27 years and you look at what these markets have done, you're quickly going to differentiate the ones where population is growing and home price appreciation is above normal versus the one where you're not.
What was Jacksonville's long-term home price appreciation rate anyway? And how does that compare to some of these other metros?
When you look back, we can pull some data from the Federal Housing Finance Agency. You're able to look and see what this home price appreciation has been over the last 27 years. You see some very sharp differences, and you also see it directly correlated with population growth. So if you look back over the last 27 years in Jacksonville, you're going to find that home price appreciation has averaged a little over 4.3%. Compared to a market like Cleveland, you're going to see that your home price appreciation has been a little over 2.4%. So doesn't mean that things are going south in the long haul in Cleveland, but it means that there's a missed opportunity to enjoy the appreciation that you could have had over 27 years.
Now, if you look at Jacksonville's 4.3% appreciation rate over the last 27 years, that's 1991 to 2018, which is the latest year we have data for, maybe you're thinking that, well, that doesn't even beat inflation by very much. And I'd agree, it doesn't. 4.3% is not very thrilling. But if you're a leverage investor and you're leveraged at 3 to 1 or 4 to 1, that's your multiplier. Take 4.3 and multiply it by 4, and there's your appreciation rate on your equity.
Absolutely. Those are those profit centers that make this not just a good investment, that take it to a great investment when you start to apply leverage.
So really, here's the point. When we talk about where cash flow intersects with long-term appreciation, think about the concept of lump sum cash flow. If you sell your appreciated property that you buy now in the future, you basically have a couple different ways that you can play that. Number one is you can take that cash and pay the tax. And the other is the 1031 exchange, which we talked about extensively, where you don't have to pay tax. And that way you would keep your gain as equity rather than cash. But that's that second option. If you decide to take that first option, which is taking the cash and paying the tax, you have just benefited from lump sum cash flow. Let's talk more about the why for Jacksonville. You know, we've talked about Jacksonville before a little bit, Greg, and interestingly, it's one of the very few markets that's on a United States coast where you're still not hemorrhaging cash flow on a monthly basis. Tell us more.
Yeah, absolutely. As I'm sure most folks would expect, me investing my own money in Jacksonville, I love it because it is that balance of positive cash flow and potential for home price appreciation. And a lot of this comes back to population growth. So when we're talking about why Jacksonville is appreciating at a rate that is almost twice what Cleveland is appreciating, it's because population is growing there, right? If you look from 1990 to 2017, I pulled the data, and population in Jacksonville has appreciated 40%.
That's astounding. And that's even more than Dallas at 33% over that time period.
There you go. Well, and you compare that to what's going on in some of the other markets. They don't compare. Many times population has decreased in some of these major markets out there, Cleveland being one of them. And so this idea of home price appreciation is not such a mythical fact anymore. When you look at historical home price appreciation and you look at where populations are growing, you can count on home price appreciation, assuming you are a long-term investor. And that's really why I love Jacksonville. We're able to cross that threshold of cash flow, and then we set ourselves up for additional success on the home price appreciation front. And then if you really want to take it to another level, you look at the benefits of leverage on top of that.
Now, if you do want to have a reasonable expectation of long-term home price appreciation, sure, in-migration exceeding out-migration certainly helps, like the 40% population increase in Jacksonville between 1990 and 2017. But talk to us about some of the strong economic fundamentals there in Jacksonville, which is positioned in Northeast Florida, because, I think a lot of people, when they think about Florida, they think about an influx of retirees, and they're certainly right. But in Jacksonville, unlike other places in Florida, they're not as dependent on the retiree influx as they are other industries. So tell us about some of those economic drivers in Jacksonville.
You're right. We are not dependent nearly as much on the retirees, and we're not dependent nearly as much on the tourism. We joke that Jacksonville is a lot more like Southern Georgia than it is many of the other
right
in Florida. It is extremely different than Miami and very different than Orlando. Our number one employer is the military. We are a large logistics town. Shipping is very important for us. We have 3 Fortune 500 companies that are here. But tourism and retirees are not the biggest driver of our economy. A lot of these stable economic anchors are really what drive us. And one of them being the port of Jacksonville. Our port is such a driver of our economic base. We're the second largest port in the state where we are right now. Obviously, it's a big driver of jobs. But the really exciting thing is what has been going on for years. And this is in a relationship to what happened with the Panama Canal. And as they expanded the Panama Canal, larger ships were able to pass through. And so all of the ports along the eastern seaboard saw the potential for this huge demand of container ships coming through. And so each of the ports along the eastern seaboard have done certain things to be able to capture that demand. And Jacksonville's been right there. So we're really excited, not just about what the port does today, but what that can mean for our economic base and what that can mean for jobs and growth, specifically of real estate, over the next 10 years, 15 years, 20 years.
Most any substantial metro area has a Fortune 500 company presence, but you actually have 3 Fortune 500 companies headquartered there: Fidelity National Information Services, Fidelity National Financial, and CSX. And the population growth there in Jacksonville, I know Jacksonville's grown a complete 2% just in the last year alone, one of the fastest growing populations in the country. And to put that in perspective, the United States lately has had a growth rate of 0.6 to 0.7% in population annually. So Jacksonville's growth rate in the last year has been 3 times the nation's growth rate.
There you go. We're over 1.5 million people now. They just released this stat a few weeks ago now, and I was surprised. 2% in 1 year for a major city like Jacksonville, that's substantial. So certainly excited about the continued booming population here.
Yeah. So since we've been talking about appreciation, compare buying a, say, $100,000 property, just for ease of numbers, in Jacksonville over the long term versus buying a $100,000 property in a metro that just doesn't have very much appreciation.
Yeah, I think this home price appreciation conversation can sound a little bit theoretical unless we put some real numbers to it. So that's what I did. I used the numbers based on the Federal Housing Finance Agency's home price appreciation tracker. I used the average home price appreciation over the last 27 years, and I applied it to purchasing that $100,000 property in a metro like Jacksonville versus Cleveland. And now I'm a big Pittsburgh Steelers fan, but that's not the only reason that I'm picking on Cleveland. It's because, and I probably don't have much time to talk about Cleveland this year because their football team's going to be pretty good. Everybody's picking them to beat the Steelers, but I am going to pick on them a little bit here because it's what the numbers dictate. And this is what I want everybody to conceptualize. This is what I talk about: a huge opportunity to evaluate home price appreciation in your decision and a huge opportunity cost if you do not. If you bought a property for $100,000 in Cleveland in 1991, based on average appreciation rates, in 2018, your house is worth $188,000.
Okay.
Which is great. $88,000 of appreciation is certainly wonderful. But it doesn't seem as great when you compare it to what that purchase would have done if it was that $100,000 purchase in Jacksonville. You bought a $100,000 house in 1991 in Jacksonville. In 2018, it's worth $313,000. That is an additional return from choosing a market that is known to grow of $125,000 on one house. And Keith, like you, I know you own many, many units. Our clients own many, many units here. I mean, you can imagine that type of additional gain times 10 rental properties or 20 rental properties. That's why I get so excited about teaching people the right way to evaluate home price appreciation, because it can make such an impact.
Yeah, just follow where the people are going, and population migration trends unfold so slowly that it's pretty easy to stay on top of this. So, any last thoughts about home price appreciation versus cash flow when an investor is evaluating a market?
Well, I think that it is just so important to look at all of the profit centers. Today, we've mainly talked about two, but I know you, in your trainings, in your podcast, I hear it over and over again about the multiple profit centers. There's cash flow, there's home price appreciation, there's tax savings, there's principal pay down. All of these things should be evaluated, because at the end of the day, we're not here just to make cash flow from our investments. We're here to make a total return on our investment. And so if you fail to recognize the other ones, you're just hurting your own ability to reach your financial goals.
Now, you offer property, turnkey property, often new construction property to investors there. Tell us about the inventory that you have now.
Yeah, so new construction has been our focus for quite a while. The Wall Street Journal actually recognized us back in 2013 as being a pioneer of building new construction rental properties, because nobody was doing it back then.
Yeah.
Well, we actually started in 2011. The Wall Street Journal picked it up in 2013. But since 2011, we've built over 500 new construction homes, and we continue to go bigger and bigger because it's such a wonderful asset for our clients to own. Like, you know, being an experienced investor, Keith, the biggest pain points as an owner of rental properties are maintenance and vacancy costs. And at the end of the day, if you have a resident who has the opportunity to rent a brand new home, the chances of them staying there a lot longer, paying a little bit higher rent and getting a premium there and taking care of your home are much stronger. And at the end of the day, that's why it works so well. So this year alone, we're going to build over 400 new construction homes. We'll be one of the largest builders here in Jacksonville. And our clients are just loving that new construction inventory.
Yeah, they're very attractive to tenants. And when you get a tenant, I know oftentimes you're signing them to 2 or 3 year leases. And oftentimes a tenant in a new construction home is willing to sign up for a long-term lease because they don't want to leave that home. No one has ever lived in that home before them.
I go back to when I was renting my house. It never even factored, meaning I was renting a house. It never even factored into my mind that I could move in and rent a house that was brand new. I mean, that just wasn't possible. So when you have that allure for a resident, they are certainly going to want to be there for a long time. And what a lot of investors forget in this entire equation is, unless we have a really happy resident, we're not going to have a really happy owner. And if we don't have really happy owners, we're not going to be nearly as happy as well. So we have to take care of those residents. We have to give them a really wonderful quality product. And when we do that, everybody else falls in line and is happy as well.
In my opinion, the real deal with buying new construction in a place like Jacksonville is you as an investor are going to have to take less cash flow up front. Rents generally go up over time, and with a new construction property, you're going to reduce your vacancy and turnover cost because you're not going to have things that break or wear out, and your tenant is going to want to live there for a long time. So in my opinion, that's really the trade-off and that dynamic that you need to think about that. That's a mindset you should have as an investor.
Absolutely. And that's a really important point to make. If there is an investor out there who's looking for the absolute max cash flow, Jacksonville is probably not the market for you. There may be a place in their portfolio for a max cash flow market, maybe like a Cleveland, but then there's also might be a place for a balanced approach. And that's the clients that come to us. They want that balanced approach. It meets the threshold of positive cash flow, and then they want to look at potential for growth. And that's why it'll work for some investors, but not for all.
And you know what? For a new construction property, or frankly, even a rehab turnkey, I don't like to hold on to a place for more than 8 or 10 years, because at that 8 or 10 year mark, that's where you might have some systems beginning to wear out, where you really have to make substantial replacement. That's the point at which I want to dump it, sell it, and do a 1031 tax-deferred exchange. And typically, like we mentioned earlier, if you have an 8 to 10 year hold time, it's quite rare that you would ever sell the property for less than what you bought it for just 8 or 10 years earlier. So that's my strategy. When equity accumulates, I want to move it along with that 1031 exchange and move it along just before things start to wear out. And you know what? With the single family home strategy, you're going to be able to sell it to a homeowner that doesn't need to make the numbers work, because they're going to be an owner occupant. That's the formula right there.
I'm a disciple of your teaching as well, because your return on equity is what, Keith?
It's always zero.
There you go, brother.
Well, Greg, let our audience know how they can learn more about you and get your report and take a look at some of your properties.
For those who are interested in learning more about our investment properties, you can go to the Get Rich Education website.
It's getricheducation.com/Jacksonville, or for a shortcut, getricheducation.com/JAX will take you to the same place where you can get a hold of a report and actually look at the numbers from some real life properties there in Jacksonville.
We are looking forward to continuing to help all of your listeners.
We've been talking about cash flow versus appreciation, a subject I love. Greg, thanks so much for coming back onto the show. Jacksonville, Florida, one of the few coastal markets where the numbers still kind of make sense. But Florida, like most places in the U.S., is seeing downward pressure on their rent-to-price ratios. That is just happening everywhere. At last check, their new construction single-family homes have a rent-to-price ratio of about 0.75 and purchase prices around $180,000, maybe a little bit more for an average now. New residents keep flocking to Florida. Now, Miami, forget it. The numbers don't make sense for cash flowing rentals there at all. But in places like Jacksonville, Orlando, and Tampa metro areas, do we have 5 years left where the numbers will still make sense? I don't know. No one does. The numbers continue to be under pressure as prices often rise faster than rents. Maybe we have way more than 5 years left. Maybe we only have 2 years remaining. Jacksonville's new construction turnkey property is typically in infill areas of the city. I have walked inside their property myself last year. Like we said, less cash flow than some markets. So they've been visionary there in buying land years ago, buying it up when it was less expensive. And that way they've had the ability to furnish new construction properties for years. So one bright spot is that they have inventory available. And they've also got a culture there unlike nearly any I've ever seen, as they've got dozens of people working in their Jacksonville office with strong, well-staffed in-house property management for you. Next week, Get Rich Education's own business developer, John Collins, comes out from the backstage and onto the front stage, as he'll be here with me on the microphone next week. Until next week, learn more about new construction property in Jacksonville, Florida, and connect with a provider at getricheducation.com/JAX. I'm Keith Weinhold. Until next week, don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Countless investors get killed on their long-term maintenance costs in their rental property portfolio, but that's far less likely when you buy brand new construction. Let me tell you about my friends at JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model that allows clients like you to invest in new construction, turnkey rental property. That's why JWB has been featured on the front page of the Wall Street Journal and other national media. If you want new construction rental properties in your portfolio, talk to JWB. Give them a call at 904-677-6777 or visit them at newconstructionturnkey.com. The preceding program was brought to you by your home for wealth building, getricheducation.com.